Let's dig into some pretty big numbers from one of the world's biggest banks. Citigroup just dropped their Q3 2025 results, and the question on everyone's mind is this. Is their massive, and I mean massive, turnaround plan actually working? Well, let's take a look at what the data says.
Okay, let's jump right in. The first thing that just pops off the page is this number, 9%. That's their year-over-year revenue growth for the quarter. Now, for a bank of this incredible scale, a 9% jump in a single quarter is a number that definitely makes you sit up and pay attention. And look, that 9% revenue growth wasn't a fluke. The strength was pretty much everywhere you looked. Revenues hit a really strong $22.1 billion. ROTCE, that's return on tangible common equity, a super important measure of profitability, it was up big time. The bank returned over $6 billion to shareholders and even bumped up the dividend. This isn't just one good number. It's a picture of a company that's really starting to fire on multiple cylinders. So you gotta ask, was this just a lucky quarter, or is there a deliberate strategy behind these impressive numbers? That's exactly what we're going to look at in our first section, Citi's transformation plan. You know, the whole strategy really boils down to three key ideas. First, simplify the bank, which basically means getting smaller and smarter. Second, enhance business performance, focusing on what they do best. And third, build a winning culture, making sure everyone is pulling in the same direction. It's all about creating a leaner, more effective, and way more focused Citi. And this slide just perfectly illustrates that shift in thinking. The old Citi was known for its massive, kind of sprawling global footprint. The new Citi is exiting 14 of those international consumer markets to become focused and interconnected. It's moving from this super complex organization to a simplified structure that's built around 5 core businesses. This is a fundamental move away from bigger is better to smarter is better. So, how's this new, focused approach actually paying off? In Section 2, let's get inside those 5 core businesses and see where the growth is really coming from. The first thing you notice here is just how balanced this is. The revenue pie is split almost perfectly among their 3 largest segments: markets, which is their trading arm, services, which supports huge corporations, and U.S. personal banking. Each one contributes about a quarter of the total revenue, and that kind of diversification is a huge part of their resilience. And when we start to dive a little deeper, the performance within each of these segments is pretty impressive. The services division, which handles things like massive cash management and trade solutions for global companies, well, it actually hit record revenues this quarter. Then you have the markets division. A great indicator of how much business they're doing with hedge funds and other big clients is their prime balances. And get this, those were up a massive 44% year over year. I mean, that is a huge jump in activity. And that momentum carried right into the banking division, the part that handles M&A advisory and helps companies raise capital. It wasn't left behind, with investment banking fees jumping a very healthy 17%. And, this strength with corporate clients often fuels the wealth management arm, which is a key area for their future growth. It just makes sense, right? Strong business relationships lead to managing personal wealth, and here they saw a record inflow of new client money. And finally, back on their home turf, U.S. personal banking also delivered a record quarter. The takeaway here is crystal clear. All 5 of their core businesses are firing, putting that enhancing business performance part of their strategy into powerful action. Okay, so the 5 businesses are firing on all cylinders. Now let's go a layer deeper in Section 3 and look at a few other key details from the quarter. We're talking tech, deals, and credit quality. A huge piece of news this quarter was this announcement right here. As part of that Simplify the Bank strategy, they're selling a 25% stake in their Mexican consumer bank, Banamex. This is a major step in their long-stated goal of exiting that business to focus on the core. Now, if you read the fine print of their earnings, you'll probably see this term pop up, goodwill impairment. It's labeled as a notable item that affected the bottom line numbers. So what exactly is that? It's basically a non-cash accounting charge. When you buy a company, the amount you pay over the value of its physical stuff is called goodwill. If the value of that acquisition later goes down, you have to write it down or impair it. Here, it was a $726 million charge tied to the Banamex deal. The really key takeaway here is that it's a one-time item. That's why you'll see them present results excluding this charge to show how the core business is really performing. Now let's talk about risk for a second. This chart shows their corporate loan exposure is heavily weighted to North America at 57%. In a volatile global economy, having most of your loans in a relatively stable market provides a really solid foundation for the whole portfolio. But it's not just about geography. It's also about quality. And this is really interesting. A full 70% of their corporate loan book is with investment-grade clients. These are the most creditworthy, lowest-risk companies out there. So the portfolio isn't just stable, it's also incredibly high quality. So we've seen a strong quarter, a clear strategy, and a high-quality loan book. This all leads to the big question: what happens now? Let's wrap up by looking at Citi's guidance and what they're targeting for the future. This is what management is telling the market to expect for the full year. They're guiding to revenues higher than $84 billion, and they plan to continue their $20 billion share repurchase program. It's an outlook that really signals confidence in their ability to keep executing. And here's the big target they're aiming for. This quote lays it all out. They're targeting a return on tangible common equity of 10 to 11% by 2026. Hitting that number would be a huge milestone in their turnaround story. Which brings us to our final thought. This quarter clearly shows the transformation plan is delivering real results, but the road to 2026 isn't just a straight line. So the question remains, can they sustain this momentum through whatever the economy throws at them and actually hit those ambitious targets? That is the story we'll all be watching.